Hello, I'm Hermione Taylor. I write the economics section of the Investors Chronicle, and I'm here to answer your economics questions via Twitter. So we have a question here from Catherine Fletcher who says, "Be right back, Googling what is a gilt." So the UK government needs to pay for things like the NHS, defence and education. It does this with a combination of tax revenues and borrowing. When the government needs to borrow, it issues something called a bond, which is where it agrees to pay back the amount it's borrowed after a set period. This could be anything from a few months to 30 years, plus a fee that it pays every 6 months to the investor. In the US, government bonds tend to be known as treasuries, but here in the UK, we call them gilts. That's because traditionally, when you invested in a UK government bond, you were given a certificate with a shiny golden gilt edge. So here we have a couple of questions on what we call asset purchases. So the first is from ITA Native Sports, which says, "What is quantitative easing?" And the next is from Theo Summers, who says, "What is quantitative tightening? Explain it to me like I'm 5." So let's kick off with quantitative easing. In the UK, we have the government who's in charge of fiscal policy, which is tax and spending. And we have the Bank of England who are in charge of monetary policy, which is to do with interest rates and quantitative easing. And their job is primarily to help the UK hit its inflation target of 2%. In QE, the bank buys up bonds, which are mainly government gilts, and this pushes up the price and pushes the yield down. This decreases the cost of government borrowing, and the idea is that this reduces the cost of borrowing for households and firms too. QE was designed to try and stimulate spending to get a bit of economic growth and help the UK get inflation back up to its 2% target. QE also impacts other asset prices too. By keeping the yield on government bonds low, QE incentivised investors to look for higher returns elsewhere, so we saw demand for other investments like property and stocks soar. It's worth noting that even though quantitative easing keeps the cost of government borrowing low, that's not really the point of it. The Bank of England is really keen to stress that it engaged in QE to try and encourage growth in the economy and help the UK get back up to its 2% inflation target. Now, if we come to our second question, what is quantitative tightening? I think it's really important to stress that QE came in a really different economic climate. It was all about trying to help the economy grow and get us back up to a 2% inflation target. Today, inflation is far above target. It's around 10%. And the Bank of England is trying to increase interest rates to cool the economy and get us back down to our 2% target. So under quantitative tightening, the Bank of England plans to sell some of the government bonds that it's purchased. This was temporarily put on hold after the gilt market turmoil following the mini-budget, but it's likely that they will resume it again sometime before the end of the year. So we have a question here from Soren Rasmussen, who asks, "What is Trussonomics?" Well, things have moved so quickly in the UK that the era of Trussonomics is already over. But it caused so many headlines and so much market reaction that it's worth having a look at what it stood for. The idea behind Trussonomics was that we could shock the economy out of a period of low growth through a combination of policies to tackle the supply side of the economy and tax cuts. The Chancellor announced the biggest package of tax cuts for 50 years, and crucially, these were what's known as unfunded. This means that the government didn't plan to cut back on spending to pay for the tax cuts. They believed that by cutting taxes, the economy would grow so much that people and businesses would end up paying more tax anyway, and the tax cuts would in the end pay for themselves. Another important feature of Trussonomics was a desire to make a break with the kind of economic policies that we'd seen in the recent past. Truss railed against something called Treasury orthodoxy, and in the end, they presented a budget that had very few costings and forecasts, and they didn't agree to have any oversight from the UK's government spending watchdog, the Office for Budget Responsibility. So the next question we have here is from @BurningT, who says, "Why did the pound have to drop right before this holiday?" I think a few things spooked currency markets following the mini-budget. The first was the scale and the speed of the tax cuts. The second is that they were unfunded. And the third is that they came without oversight from the Office for Budget Responsibility. All of this combined to make the UK look like a less attractive investment prospect, and we saw the price of sterling drop relative to other currencies. The pound actually reached a record low briefly after the mini-budget, and it got to the point where £1 bought you $1.04. For context, back in 2007, a pound could buy you $2. So great point to raise about holidays. A weak pound means that you get less foreign currency for your money, which makes buying things overseas more expensive. It also makes it more expensive if you want to import foreign goods. This is a significant problem for the UK economy because we import gas and petrol, which we usually pay for using dollars in international commodity markets. So when the pound is weak relative to the dollar, we get a lot less bang for our buck there. So a question here from Gilda Paulus, who asks, can Sunak keep the triple lock on state pensions when inflation is over 10% and the working people who in reality pay for it through their taxes are already so hard hit? This is a great question. So in the UK, pensions are supposed to increase in line with whichever of these three things is highest: inflation, 2.5%, or the average wage increase. In the UK at the moment, inflation is by far the highest measure. It's at over 10%, whereas average wages are increasing at a much lower rate, around 5.5%. The government's finances are under strain, and there's been a bit of talk recently about whether relaxing the triple lock could provide some breathing space. The think tank, the Resolution Foundation, has estimated that if the government increased state pensions in line with average wages instead of inflation, it could save around £6 billion. But this might be politically difficult to do. Question here from Hawkeye, who asks, why is inflation so high worldwide? Well, inflation is pretty high worldwide. We have countries like Turkey who have got inflation of 80%. Here in the UK, we're around 10%, which is similar to the Eurozone, and the US has about 8% inflation. In other countries like Japan and China, it's lower. They've got inflation of about 3%. That is still a level that we would have considered too high just a couple of years ago. There are a couple of global forces driving this. The first is bottlenecks arising from the pandemic. When everything shut down and reopened, we saw huge shortages, which is pushing up prices. The second is the war in Ukraine, which has disrupted food production and gas supply, which has meant higher food and energy prices. And rising energy prices are a big driver of inflation in the UK and Europe at the moment. But countries are also dealing with domestic inflationary pressures too. We've got very strong consumer demand. This is due to something called revenge spending, where people have got pent-up savings from the pandemic. We've got very low unemployment, which means that workers might be tempted to ask for higher wage increases. And we've got firms pushing prices up. So another question here from Bruce Haswell, who asks, how big is the UK deficit? All governments run a deficit pretty much all of the time. What's the problem with having a deficit? Great question. When the government spends more than it receives in tax revenues, it has to borrow to cover the difference, and we call this gap the deficit. In 2020, the deficit was huge because of all the spending that COVID entailed. It was equivalent to around £4,800 per head of the UK population. The UK isn't a huge outlier compared to other G7 economies in terms of its deficit. And some people were confused why markets reacted so badly to the government planning to increase spending when other countries do something similar. There are a couple of problems with having a government deficit. When governments borrow, they need to persuade investors that the borrowing is going to be sustainable and it's carefully costed. Another problem with UK government borrowing is that the government issues a lot of its borrowing in something called index-linked gilts. These are gilts which are linked to the rate of inflation. It means that when the government repays these gilts, they adjust the sum that they pay back and the 6-monthly fee in line with inflation. This isn't a big problem when inflation is low, but today it's over 10%, and this is making government borrowing very expensive. Though other countries do issue some debt as part of index-linked gilts, it's a very small proportion. Here in the UK, it's around a quarter of our debt. This means that in times of high inflation, UK borrowing gets very expensive indeed. We have a great tweet here from Kathleen Brooks, who says, what is the end game for UK gilt yields? The 10 and 30-year yields are both up 30 basis points today. A change of government might be the only thing that calms markets. The UK bond market is basically crying out for an election. Since this tweet, we have basically had a change of government. We've had a new Chancellor, a new Prime Minister, and a new Cabinet. Gilt yields have returned to about the level they were before the mini-budget. Some analysts were saying that after the mini-budget, investors required a moron premium, so an extra incentive to lend money to the government. This has now been replaced with what some analysts are calling a dullness dividend. Markets generally think that the economy is in good hands, and gilt yields have gone back down again. But they are still a lot higher than they were in the summer, and it's not clear that this is entirely to do with politics. Investors also care about the state of the economy that they're investing in, and they worry about things like recession risk and inflation and what this might do to interest rates. This also impacts gilt yields and the gilt market.